Hello, everyone. Good afternoon. Welcome to Questrade's webinar series. Thank you for joining us. My name is John, and I'm going to be your host today. Our webinar today is on alternative ETFs, the untapped portfolio diversifiers. And joining me shortly is our very special guest from Accelerate Financial Technologies. Before we get started and introduce Julian, let's quickly go through our agenda and some housekeeping items. So here's our agenda for today's webinar. First, we'll go through some webinar details, discuss when the recording will be available, and read through a quick legal disclaimer. Next, we'll introduce our special guest and speaker from Accelerate and jump right into the main event. And lastly, we'll wrap up with a live Q&A session near the end of our webinar today. Some quick housekeeping items. So today's session will be recorded and we'll have the on-demand version available early next week. If you have to duck out early or would like to rewatch an important section, we've got you covered. Keep an eye on your email inbox for the recording, as well as the main Questrade website. If you have any questions during the presentation for Julian, please type them into the Q&A window available at the bottom of the Zoom interface. We'll try to get to as many as we can at the end of the presentation. And if you're having technical issues or have general questions about Questrade or trading, please feel free to message one of our Questrade support agents via direct chat. All right, and a quick legal disclaimer before we get started. Let me try to read through this as quickly as possible for everyone to make this pain-free. The following webinar is presented by Accelerate Financial Technologies. The information Accelerate provides in this webinar is intended to be for educational purposes only. The information and any opinions that may be expressed in this webinar do not constitute advice or recommendations by Questrade Inc. or its affiliates with respect to investment in financial instruments, nor does Questrade recommend or endorse the views or opinions expressed in this webinar. Your use or reliance on this webinar information offered by Accelerate is subject to the Questrade legal notice. Questrade is a registered investment dealer, member of the Investment Industry Regulatory Organization of Canada, and a member of the Canadian Investor Protection Fund. Questrade cannot guarantee the timeliness, accuracy, and reliability of the information provided by Accelerate, and Questrade will not be held liable nor assume any liability for loss or damages arising directly or indirectly from the use of this webinar, information or services, or that may be discussed. Any liability, whether direct, indirect, or consequential loss or damage is explicitly disclaimed, and this webinar should not be relied upon to evaluate any potential transaction. Viewing this webinar should not constitute the giving of investment advice by Questrade. Consult with your financial advisor or ensure you fully understand any financial instrument or product before investing. Any information or testimonials relating to past performance of securities discussed in this webinar does not guarantee future performance. Phew, all right, thanks for bearing with me there. That sounded a little like an infomercial. But now, without further ado, I'd like to introduce our guest speaker today, Julian Klymochko. Julian is the CEO and Chief Investment Officer of Accelerate Financial Technologies. Before he founded Accelerate in February of 2018, he was the Chief Investment Officer of Ross Smith Asset Management, where he managed a number of award-winning alternative investment strategies for nearly a decade. He started his career as an analyst at BMO Capital Markets, and Julian attended the University of Manitoba, where he graduated with a Bachelor's of Science in Engineering and a Bachelor's of Commerce in Finance, both with distinction. Not only is Julian a chartered financial analyst, but currently he is a director of the CFA Society in Calgary and the chairman of Bitcoin Well. Julian's also been featured in some of the world's top financial and business media, including Bloomberg, CNBC, The Wall Street Journal, BNN, Business Insider, and the Globe and Mail. So we're very excited to have him here with us today. With that, I'd like to pass it on over for the main event. Take it away, Julian.
All right, thank you very much, John, for that introduction, and thank you for having me on the webinar today. Excited to talk to everyone about alternative ETFs, the untapped portfolio diversifier. And that's really the name of the game today. I'm going to talk to you about how to best diversify a portfolio using easy to use liquid low cost ETFs. So let's get into it today. As a reminder, if you do have any questions, please put them in the Q&A and I'll be happy to answer them at the end of the show. There's a lot of content in here, so I'll try to get through it relatively quickly so we can have more time for Q&A. So another disclaimer here, I'll save you from the pain and give it a read, but we'll go into the material. So to set the table, let's just first discuss what exactly are alternative investments. Well, alternative investments, think of basically everything besides traditional investments, stocks, bonds, and cash. So on the alternative side, there's either liquid alternatives such as hedge funds, commodities, cryptocurrencies, Bitcoin, and then there's the illiquid alternative side of the ledger being private equity, private debt, venture capital, infrastructure, etc. So the goal of alternatives, they basically encompass a large opportunity set that differ from stocks and bonds and generate returns just in a different way than traditional asset classes. So the main reason why an investor would choose to allocate to alternative investments is, as we indicated, diversification. Now, what does diversification mean? What's the real goal of diversification? That is to reduce volatility, reduce risk in your portfolio. When one thing zigs, like for example, stocks, when those zig, hopefully other asset classes zag, or at least zig less. So we're talking about downside protection, perhaps an alternative strategy that can go up while your stocks are dropping. That's a main consideration, is just diversifying our portfolio and reducing risk and volatility. So this chart here, I want you to focus on one key takeaway here. The x-axis shows the number of asset classes in an investor's portfolio. And if you see, there's a line on the number 6 that heads to a star. And then on the y-axis, we show the portfolio volatility, also known as a quantification of portfolio risk. And what this graph shows mathematically is that the ideal place to be in terms of mitigating risk within your portfolio is 6 uncorrelated asset classes. And by uncorrelated, we mean investments that move differently than each other. So in my opinion, just owning stocks or just stocks and bonds, that's only 1 or 2 asset classes. And for optimal diversification, I believe that an investor should have 6 asset classes within a portfolio. Some statistics here. So if you own just stocks, adding 1 uncorrelated asset class to your portfolio may reduce risk by 29%. Then utilizing 6 uncorrelated asset classes and diversifying our portfolio may reduce risk by nearly 60%, 60%. So that's significant. Another thing that I want to talk about is kind of the history of asset allocation, because alternative investments may be new to a lot of you on the webinar today, and at some point they're new to everyone. And believe it or not, at some point back in time, if we go back in time, call it 100 years ago, stocks were deemed incredibly speculative and institutional investors would not own them. That's right. So if we go back 120 years, the only securities that institutions would own, the only assets would be government bonds, real estate, perhaps some preferred shares. They deemed stocks as too speculative and they would not own them. So imagine how things have changed over time. Then go back about 80 years ago, institutions started to add corporate bonds, stocks, additional debt. And then over time, things continued to mature. New asset classes came out, corporate bonds, emerging market stocks. And then since the 80s, you've had a ton of different asset classes: high yield debt, small cap, and alternative investments. The main driver of alternative investments, if we look at the graph on the right, is the dramatic long-term decline in interest rates. For example, institutional investors, such as pension funds and endowments, generally seek to return 7 to 8% per year to satisfy their constituents and meet their return targets. If we go back to 1995, you could earn 7.5% per year with a 100% bond portfolio with a portfolio volatility of just 6%. Fast forward 10 years later to 2005, bond yields have declined dramatically. Now to generate that 7.5% return, you now had to take 50% more risk, as your volatility went from 6% to about 9%. And the bond portfolio got cut in half to roughly 50, replaced by equities and alternatives, real estate, private equity, etc. Fast forward another 10 years to 2015. Now to generate that exact same return, you had to basically triple your risk and heavily weight to equities and include more alternatives. So the dramatic long-term decline in interest rates and the lowered expected returns for bonds, in addition to the lowered expectations of returns for stocks, is the key driver on institutional investors' pursuit of alternative investments. And we have only seen that trickle down to every other type of investor, whether a family office, whether they're an investment advisor, or whether they're even a do-it-yourself advisor. And that's what we've seen historically back when institutions started buying stocks 100 years ago. It was perhaps another few decades before individual investors were really comfortable owning them. Same with high-yield bonds in the 80s, hedge funds in the 90s. The institutional investors really and family offices were the pioneers, and then it was adopted by other investors over time. And now I run into many individual investors who will perhaps own a junk bond ETF or a preferred share ETF. And that's, significant progress in accessibility of those asset classes that, 30, 40 years ago were fairly new. So this is a really interesting graph just to conclude the conversation on endowment style investing. I'm sure some of you may have heard the Yale endowment model of asset allocation, where they're diversifying beyond just stocks and bonds, and they're having a whole host of alternative asset classes within their portfolio. So if we look at the graph on the right here, this shows, and it segments college and university endowments and foundations by the amount of their endowment size. So the red dashed line, it just highlights the percent of their portfolio of these endowments in alternative strategies. So the top line, 58%, that refers to the largest endowments in the United States with over $1 billion in assets under management, allocate 50%, 58% of their portfolio to alternative investments. Now, if we go down to the smaller endowments, they generally allocate, less, but even the smallest endowments under 25 million, they allocate roughly 11% to alternatives. And what we'll see later in this presentation today is that now, with the advent of alternative ETFs, individual investors now have the same investment options as these multi-billion-dollar endowments. So this is a really interesting slide because there was a poll run on what the average investor expects to return. And so that was 10.9% annualized over the next 5 years, which is certainly a high return expectation. Now, if we contrast that to the average analyst forecast for the traditional 60-40 portfolio, and by 60-40, I mean 60% stocks, 40% bonds, the classic two-asset portfolio, analysts believe that will earn just 2.8%. If you look at the 10-year bond, it's currently yielding roughly 1.2%, corporate bonds slightly higher, equity valuations in the US at all-time record high valuations. And so analysts think going forward that 60-40 stock and bond portfolio will produce returns that are significantly below investor expectations. And that is one reason why we see the difference between the average retail investor allocation to alternatives at just 5% and the average institutional allocation to alternatives at 52%. So I wanted to get into what some of the various alternative investments are out there, because alternative investments encompass a massive amount of different asset classes, different strategies. So I wanted to focus on one right now, and that is of hedge funds. So hedge funds are typically investing in liquid markets, long and short, whether it's equity markets, credit markets, derivatives, with the goal of generating outperformance above a specific benchmark. So hedge funds can utilize leverage, short selling, and short selling is betting against assets or betting that they will fall in price. And there are a number of common hedge fund strategies: long short equity, arbitrage, global macro, activist, event-driven, convertible arbitrage, etc. So why would someone want hedge funds in their portfolio? Well, the graphs here show a few past bear markets for the Canadian benchmark, the TSX Composite, in the orange line, and the blue line shows the average Canadian hedge fund performance. As you can see, in 2008, it mitigated your downside by roughly half. Then in the bear market of 2015, hedge funds were actually up when the index, the equity index stocks, were down double digits. So that is one of the main use of hedge funds, is mitigating downside risk when equity markets decline. I wanted to highlight one specific alternative investment strategy that I have been running for over a decade. So I'm a bit of a specialist when it comes to arbitrage and SPACs. And it's something that I'm pretty excited to introduce to you if you've never heard of it before. And if you have, going to do a bit of a deep dive into how this one specific alternative strategy works to generate what we consider heads we win, tails we win big, a really cool risk return profile for investors that's perhaps unmatched in any other strategy. So an introduction to SPACs is that each decade, we kind of see a new asset class be created and grow. For example, in the 1980s, that was the decade of, they called it the go-go 80s. You had this huge growth, birth and growth of leveraged buyouts, which were financed by junk bonds or high yield bonds invented by a guy named Michael Milken. And so the 1980s were really all about those junk bonds, high yield bonds, non-investment grade credit growing like crazy to finance leveraged buyouts. Then the 1990s was a great equity bull market. This was a decade of the star mutual fund manager, Peter Lynch, Michael Price, gracing the covers of magazines. And mutual funds really allowed everyday investors access to stocks, basically for the first time ever, people that weren't millionaires. Then in the 2000s, you saw dramatic growth in complex credit products that ended up fueling a big housing bubble in the US. You probably heard some of them: CDOs, CDSs, credit default swaps, mortgage-backed securities. And as we know, those got a little bit too popular, created a bubble and a resulting bear market and the Great Recession. 2010s, I believe, were highlighted by the growth of ETFs, low-cost index investing, and active ETFs, really popularized getting access to various strategies in an easy-to-use, liquid, and low-cost manner. 2020s, I mean, we're just 1 year in, but I believe the 2020s could be the decade of the SPAC. So what exactly is a SPAC? I've already talked about it for about 5 minutes. So let's clarify what this new asset class is. Well, it stands for Special Purpose Acquisition Company. So they're also known as blank check companies. Basically, they go public, they trade on a stock exchange, typically the New York Stock Exchange or NASDAQ, and they don't have any operations. They just have a listing and a bunch of cash. So they're a cash-rich shell company that raises money from investors in an IPO seeking to buy a private company and take them public. So the easiest way to think of a SPAC or a special purpose acquisition company is as a vehicle or a conduit to bring a private company to the public markets. So SPACs, there's nearly 600 of them outstanding currently, and they're very boilerplate, meaning they all tend to look very similar, except they're managed by different people. So the average SPAC initial public offering has a unit issued to investors at $10 per unit on its IPO. Notice how I said unit, not share, because each unit is typically made up of one common share plus a fraction of a warrant. Generally, it's 1/3 of a warrant, 1/2 of a warrant, exercisable at $11.50. Just a quick thing on warrants. If you don't know what a warrant is, it's very similar to a call option, but generally has a time frame to expiry of 5 years. So it's a derivative on the stock. Then after 52 days, these SPAC units that were issued in the IPO, they split into their two constituent parts, the common share and the warrants. So you'll see hundreds of SPAC warrants trading out there. I know many retail investors like to speculate on the SPAC warrants because they can be highly volatile, but that's a whole nother topic. And when a SPAC IPO completes, the proceeds, say they raise $300 million, those proceeds go into trust. And that trust will own short-term, low-risk US Treasury bills, perhaps the lowest risk asset globally. And the management of that SPAC cannot touch that trust until they complete a business combination. So that trust will accrue interest from these T-bills over time, and it cannot be used to fund the operations of a SPAC. Now, this SPAC then goes on the hunt for a business combination or an acquisition with a private company. They generally have 24 months to complete it. If they do announce a deal, a merger with a private company, say with a DraftKings or something like that, Virgin Galactic, then shareholders will vote on the deal, and right prior to the vote, they give you the option to redeem your SPAC common shares for $10 plus accrued interest. So that's really the key to SPAC arbitrage, is having that redemption feature at the maturity of the SPAC. You can also maintain your warrant. You can sell the warrant, crystallize it for money. But if no deal is executed after those 2 years, they will liquidate, pay you back your $10 plus accrued interest. So SPACs, they just have very standardized terms. There's nearly 600 of them outstanding currently. So if we look at SPAC issuance, there has been a massive boom. Specifically in 2020, they raised over $82 billion, which was about five-fold 2019, which was also a record. And year to date, SPACs have raised over $110 billion, just over halfway through 2021. We're way above what SPACs raised last year. So SPACs are a very new asset class. They basically just came up out of nowhere last summer. If you look at the chart on the right, this is monthly SPAC IPO issuance. So if we rewind to last summer, all of a sudden SPACs were IPOing over $10 billion worth per month. And then Q1 this year, at one point, there were over $30 billion of SPAC IPOs per month. We've gone through a bit of a big party and now a hangover ever since April. There's been a reduced amount of issuance, but nonetheless, publicly traded SPACs trading in the US represent roughly $200 billion asset class. And if we look at Q1 2020, back then it was 20 billion. So it's grown tenfold over the past 16 months. You may be thinking, what's the deal with SPACs? Why do they exist? What is the purpose of SPACs? Well, as I indicated earlier, SPACs can generally be viewed as a conduit or a vehicle to take a private company public. So a private company is growing, they have significant size. They're like, okay, it's time to list on the public markets, tap the public markets, and get some liquidity for our early backers. If a private company is evaluating going public, there's three ways to go public. Number one, the traditional IPO, initial public offering. This is how, for example, Microsoft and Apple went public. Then there is, the IPO comes with money raised, but what we've seen over the past 20 years is the IPO not be used for growth. It's typically used as an exit opportunity for earlier backers. Then there is a direct listing, which is used by popular companies that don't need the capital. For example, Coinbase listed by a direct listing. It doesn't come with a capital raise. They just go out, list their stock in the market, and it trades where it trades. Then third, there is the blank check company or the SPAC, where they execute a reverse merger. A private company executes a business combination with a SPAC, takes over its ticker and its cash, and then lists. So there are a number of advantages of SPACs over direct listings and IPOs. For example, a direct listing is only appropriate for a mature company that doesn't need capital. So for the vast majority of companies going public, a direct listing is not appropriate. So the main comparison is SPAC versus traditional IPO. So number one, a SPAC can be done very quickly in as little as 3 months. Meanwhile, an IPO can take as long as 18 months to complete. And if we look at the opportunity to raise capital and go public at an attractive valuation, a lot can happen in 18 months. If we look at what's happened over the past 18 months, I mean, we went through the whole COVID pandemic and the biggest bear market ever. So that's something that private companies definitely keep in mind, is how quickly can we raise this capital and get up and trading. Then there's the marketability. In a traditional IPO, the company going public can only talk about historical results and not forecasts. A company going public via SPAC can disclose forecasts and estimates on a go-forward basis, and that's important for earlier stage companies that don't have much to disclose by way of historical financial statements. For example, there's a lot of pre-profit and even pre-revenue companies going public via SPAC. Then there's a certainty. Traditional IPOs tend to price the night before, so the company going public won't know their valuation or where they're raising capital. But a SPAC, you're only negotiating with the SPAC sponsor and the private company, so just those two parties. And lastly, the amount of capital that you can raise for a certain company size is significantly larger for a SPAC than compared to a traditional IPO. So there's positives and negatives as we compare SPAC or IPO as a way of going public. So who buys SPACs? It's generally hedge funds who are the main ones buying SPACs, but there are a lot of individual retail investors buying SPACs these days because it really allows access to earlier stage growth companies that they have never had access to before. So hedge fund arbitrageurs generally are the main SPAC buyers because there's a really interesting arbitrage mechanism, which I'm going to get into at a later time within this webinar. So on a SPAC IPO, you have the hedge fund investors buying, and then once a SPAC announces a business combination, say it's DraftKings, Virgin Galactic, Grab, one of those companies. Once they announce that deal, you tend to have retail investors come in because they're excited to own this new company. Hedge funds cycle out of the stock, and then once the deal closes, after 3 to 4 months, you now see mutual funds, index ETF buy off the retail traders once the deal closes. So there's this circle of life that happens when a SPAC IPOs, when it announces a deal, then when it closes a deal and starts trading as the new entity. So why do sponsors issue SPACs? Well, bottom line is they get basically 20% of the SPAC as nearly free shares. So they get very cheap shares if they can successfully do a deal. They got to put up at-risk capital in order to fund the SPAC's operations, legal fees, investment bank fees, underwriting fees, etc. So if they don't get a deal done, then they lose all that money and they lose all their shares. But if they do get a deal done, it can be highly lucrative. Why are investors demanding SPACs and why have they become so popular? Well, it's basically a confluence of supply and demand. So on the supply side, I just highlighted how they can be very lucrative for SPAC sponsors if they put together a successful deal. Then on the demand side, one misconception within markets over the past 2 decades was that for a company to go public, they needed to be mature, they needed to generate consistent results, and they need to be profitable. Well, what a SPAC such as Virgin Galactic proved, which was extremely successful and popular, specifically with retail investors, that proved that there is this massive inherent demand for early stage companies, pre-profit and sometimes even pre-revenue, that this contingent of individual investors, retail investors, mutual funds, they never had access to those investment opportunities before because it was reserved for venture capital and private markets. So many companies going public via SPAC these days would be considered traditional venture capital type funded businesses, but now are going public via SPAC, giving investors access to early stage growth opportunities like Open Door, ChargePoint, Quantum State, Lordstown, Hyliion, Velodyne, LiDAR, etc. You got to remember, these are all like venture capital type investments, highly risky. They could represent tremendous upside or they could go to zero. So that's an important thing to keep in mind. But investors wanted those early stage growth opportunities that they never got access to before. So there's tremendous demand for those. So if we look at recent SPAC performance in this chart, looking at the orange line, they've been flat for months. We went through a huge bull market in Q4 into Q1, but ever since the market peaked in February, it went to a bear market in March, and now we've just been flat. A lot of the excitement has left the SPAC space, but what I know being in this market for so long is it's highly cyclical and goes from scorching hot to ice cold, sometimes many times per year. So it's highly cyclical and it won't stay in a bear market forever. The chart on the top shows the average arbitrage yield, where you can earn these low risk profits that, in my opinion, are more attractive than bonds by arbitraging SPAC. So that current yield is about 1.7%, and SPACs are still down double digits from their peak in the spring. So having access to SPAC IPOs, traditionally, individual investors don't get that access. However, it's not really a big concern these days because most SPACs going public are trading at or below $10. This allows everyday investors access to not just the same deals that institutional investors and hedge funds are buying, but access at a better price. You don't come across that very often at all. For example, in January and February, a SPAC IPO would immediately trade to $10.50, $11, and now they're basically immediately trading down to $9.95. So a compelling valuation, in my opinion. So let's get into how to arbitrage SPACs. The way you view arbitrage, and I'll just spend a minute explaining what it is, you're seeking to generate profits in the market, irrespective of market direction, by capitalizing on inefficiencies between securities prices. Like one example of, say, retail arbitrage would be buying a product on Amazon at $40, immediately selling it on eBay for $45, pocketing that $5 spread. That's an arbitrage. Warren Buffett's described arbitrage as one of his favorite strategies. He had a saying where he mentioned in one of his annual letters, teach a man to fish, you feed him for a day. Teach a man to arbitrage, you feed him for life. It's one of my favorite quotes, and Warren Buffett generated his best returns trading arbitrage in the 60s, 70s, 80s, and 90s. So the way that SPAC arbitrage works exists for basically two reasons. So number one reason is the SPAC, remember there's this trust that holds all the money. Within that trust, there's low risk treasury bills. So we're generating yield on those treasury bills. That's number one. And then number two, SPACs can trade below their $10 cash value, or what we call the net asset value now. So you can generate yield from SPACs with a combination of two things. Number one is the yield on the treasury bills, and number two is the NAV discount. So say if you're buying a SPAC at $9.90 and it has $10 in cash and matures in a year, well, that's a 1% yield on that discount. And then the second part of the SPAC arbitrage trade is that of optionality. So you remember that SPAC units come with warrants, and these warrants can be very valuable, sometimes worth $2 or more, and you can get sometimes half a warrant per unit. And then there's the optionality of stock upside. If a SPAC announces a deal like a DraftKings and it goes from $10 to $15, that's a massive win in your pocket, and you can monetize that stock upside optionality. So I'll walk you through a quick example here. This SPAC was called Vecto IQ, and this is the one that did the deal with Nikola, which is somewhat notorious company for a number of shenanigans that we won't get into today. Nonetheless, if we look at the orange line, that represents the SPAC's net asset value or the cash value in trust. You can't really notice it, but it's slowly rising over time as the trust accrues interest on its treasury bills. So if we go back to May 2019, the blue line is the share price. So the share price was roughly $10, the NAV was roughly $10.50. So you could buy at a significant discount to the net asset value and generate that 5% spread, or at least hope to upon maturity. However, as you can see in spring of 2020, when they announced that business combination, the stock immediately shot up 50% to $15 per share, allowing an arbitrage to monetize that upside optionality and get a return far higher than the original 5% expected. This upside optionality we refer to as the SPAC pop. There's a number of SPACs here. As you can see, they're trading right at $10. They announce a good deal, and they immediately rally significantly. For example, CIIG merger, they did a deal with the electric van manufacturer Arrival, and the stock rallied as high as nearly $40. Pivotal Investment Corp 3, they announced a deal, rallied to north of $13. They announced one with XL Fleet. Then the first Longview SPAC, they announced a deal with Butterfly Network. The stock rallied to over $17. So this just shows that upside optionality, which can occur in a certain market environment. But my favorite part of SPAC arbitrage is the low risk nature of it. So you can think of a SPAC as a T-bill that has a conversion right to a stock. And so you have the risk profile of a T-bill, but the upside of equity. So that's really cool. You can picture it as an equity with a put option at $10 because you can always redeem your SPAC before the deal vote at $10 plus accrued interest. So that is extremely important to remember, that redemption floor will limit your downside risk on a SPAC share. I wanted to warn investors of a number of risks within SPAC arbitrage. I see two main risks. So number one is mark-to-market risk. If we go through like a COVID or a great financial crisis, spreads are going to blow out. That sweet SPAC deal that you bought at $9.90 to generate that arbitrage spread, well, if the world's ending, it's going to trade lower. Like in the COVID pandemic, we saw SPACs trading at $9.50, and they were down pretty significantly. So spreads widening in that arbitrage, and you may be forced to sell at that time and crystallize losses. Number two, and I see this pretty often, investors who miss the redemption, the floor falls out. You can no longer redeem at $10. Next thing you know, the SPAC's trading at $7, and you lost a lot of money, scratching your head. What the heck happened there? So I consider SPAC arbitrage simple, but not easy, presents a number of risks, but when executed properly with good operations and good tracking, you can generate exceptional risk-reward dynamics. I wanted to mention one last arbitrage, the SPAC arbitrage in the units. As you remember, a SPAC unit is a common share plus a fraction of the warrant. So if we can buy a SPAC unit at or below net asset value, and if you go back a few slides to the recent IPOs, the majority of those are units and the majority of those are trading below $10. So there's currently 149 SPAC units that have announced a business combination, and they're trading at an average premium to net asset value of 11.2%. So that's really the arbitrage right there, is buy a basket of undervalued SPAC units at $9.95, $10. And on average, they've been trading to north of $11 in the current market environment. Why is it trading to $11? Well, the SPAC shares may rise upon deal announcement, but the warrants generally do well on deal announcement as well. So the average warrant price is $1.30 per warrant. As you remember, when we're buying those units, we're getting those warrants for free. So there's some attractive yields, arbitrage yields available in common shares approaching the vote. So what we mean by yield is an annualized return. For example, if there's a SPAC vote in 1 month and you can buy the SPAC at $9.90 and redeem it for $10 in 30 days, well, that's a 1% return in a month, or a 12% annualized return, 12% annualized yield. That's how an arbitrager approaches these types of opportunities. So one thing I also wanted to touch on, like an arbitrager always exits the SPAC when the redemption period ends. Either you sell it if it's trading at a premium to its trust value, or if it's trading at a discount, you redeem it for the $10 plus accrued interest. Obviously, some hold on past the vote, which is called a de-SPAC or a post-SPAC equity. It no longer has this redemption floor, so presents a complete different risk profile and is the new entity. The private company is now public, took over the SPAC ticker, and is going to trade where it's going to trade. So these can be highly volatile. There are 114 of them have closed over the past year. currently up on average 18.3%, but on a median basis, up only 3.5%. So what we find in de-SPACs, or SPACs that have closed their business combination, is they follow somewhat of a Pareto distribution, which means some 80% of the returns are generated by 20% of the SPACs. So you have a handful of big winners, DraftKings, etc., and a large number of losers. Also wanted to touch on the redemption process. Many individual investors are sitting on a SPAC that's at $9.90. They're like, geez, I want to get that $10 plus accrued interest. That's a great arbitrage trade, and it's relatively low risk. I want to pursue that. Well, this is kind of the process. The SPAC will IPO. They'll announce a deal. Typically, that takes roughly 9 months. And then between deal announcement and deal vote is generally 3 to 4 months. And the redemption date is 2 business days prior to the vote. You got to get your instructions into your favorite Questrade representative for them to effect that redemption for you and get your redemption proceeds, $10 plus accrued interest. You can hold on to the warrant if you have the units, or you could sell the warrant, but the redemption process is a key step in SPAC arbitrage if you want to affect this strategy. The main reason I like SPAC arbitrage is the diversification benefits. As we discussed, this whole webinar has been focused on alternative investment strategies and the diversification benefits that they can bring to your portfolio. So if we look at the performance for the first 5 months of 2020, which included the fastest bear market of all time, March 2020, the COVID pandemic. I'm sure we all still have a bit of those scars. We haven't forgotten what happened there. Well, the bond index, supposedly safe bonds, they had volatility of 7.7%. They fell nearly 9%, peak to trough. And over the first 5 months of 2020, bonds returned 2.1%. If we compare that to our SPAC index, SPACs returned 3.8% over the same 5 months. So 170 basis points higher than bonds. By April, SPACs were already making new all-time highs. They had a volatility of 5.3%, so 31% less volatility than supposedly safe bonds, and a peak drawdown of just 6.6%, so a 25% lower drawdown than bonds. So going through the most volatile period since the global financial crisis, that is the COVID pandemic of Q1 2020, SPACs way outperformed bonds. They had better returns, lower volatility, and lower drawdown. And the best part is, when we're talking about correlations, zigging when your other assets are zagging. Over the first 5 months of 2020, SPACs actually had a slightly negative correlation to bonds and a negative correlation with stocks, meaning they moved completely differently than those traditional asset classes within your portfolio. So that's something key when considering diversification. I wanted to make a note. If you own 50 stocks, but they're all junior oil stocks, those are all highly correlated. And even though you own 50 of them, that's not being diversified since they all generally move the same way. They can be viewed as one asset. So to have true diversification, you need asset classes with low or even negative correlation, which is why stocks and bonds pair well with each other, but those are only 2 asset classes, remember. So I'll wrap things up and leave some time for questions. In conclusion, alternatives represent a great way to help diversify your portfolio. There are a number of alternative ETFs accessible to everyday investors, Questrade investors. If you want to trade them on the TSX, I run a number of them. Be happy to chat about those. Now, to focus our discussion on the SPAC arbitrage, I mean, SPACs are a rapidly growing asset class. They're popular with individual investors. They represent a way for high growth, early stage companies to go public, and a way for individual investors and institutions to get access to those through publicly traded SPACs. In addition, they offer arbitrage great investment opportunities with low risk and potential high return. So that's why we consider SPAC arbitrage as equity upside combined with the risk profile of T-bills. Like I said, heads we win, tails we win big with SPAC arbitrage. And I think this strategy, along with other alternative investments, and there are SPAC arbitrage strategies available through ETFs, accessible to all investors that trade on the TSX. this will really help you get that diversified investment portfolio. And with the tools available today through alternative ETFs, individual investors, like all you guys from Questrade, you can create pretty much the exact same portfolio as the Yale endowment, the Harvard endowment. You've never had these tools before, but now you do through alternative ETFs. So it's a pleasure speaking with you today. Follow me on Twitter at Julian Klymochko. I tweet a ton of data, interesting market commentary. I'm battling it in the markets every single day. If you want more information, feel free to email me, give me a call, check out our website, accelerateshares.com, if you want information on our alternative ETFs. And John, that concludes my webinar today. Let's get into some Q&A.
Awesome. Thank you so much, Julian. Just wanted to say thank you again for that incredibly engaging and exciting presentation. I know I learned a lot, and I can definitely speak for our customers as well, that I'm sure everybody who attended today learned some new things about SPACs and investing in them. So we've got a couple of questions that have come up. I think I'll start with the most topical, since we were just talking about this. Are there any arbitrage ETFs on the TSX specifically?
Yep, there's one, and that's the one I run, the Accelerate Arbitrage Fund ETF. The symbol is ARB, ARB, and it trades on the Toronto Stock Exchange. We launched it about 14 months ago, and it presents the easiest way to get access to these arbitrage opportunities. We currently own roughly 240 SPACs, and we're monitoring them every single day for you. We get access to all the SPAC IPOs as well. And we have a team working full-time on these for it. So if you want to do SPAC arbitrage by yourself, it's great. But I got to warn you, it takes a ton of work if you want access to it, but don't want to do any of the work. I always say you can let us do it for you, buy ARB, and then go to the beach.
That's awesome. No, sounds like a great solution. And for more info, you can always head to accelerateshares.com as well. On ARB specifically, or any of the other tickers that Julian's firm offers. I've got a few more questions. One that came up about the tax treatment of gains or losses from SPAC ETFs specifically. Can you touch on that a little bit about the tax treatment?
Yeah, so the tax treatment is via capital gains. It's fairly simple.
Nice. Okay, that's pretty straightforward then. So capital gains. So ideally, you want to own these in a registered account, but unfortunately, we can't give investment advice. So please explore those opportunities on your own there. So we've got a few more questions we'll get through here, and then we're going to wrap up in a couple of minutes. Where is a great place to search for SPAC opportunities on my own? Is there any sort of research website or database where I can look for newly listed SPACs?
Yeah, so we publish our monthly SPAC monitor on our website, accelerateshares.com. There's some other providers. There's SPACtrack.net, there's SPACinsider.com, there's SPACresearch.com. There's a big community on Twitter. You can follow my account. You can follow, there's a bunch of others, SPAC Guru, SPAC Insider. There's, a ton of analysts and firms covering this area. And then institutional investors have access to all the banks that cover it as well.
Awesome. Thank you, Julian. We're going to do two more here. This one's a bit topical. I'm not sure if you can help. We had a question from the audience. Why was Oatly, OTLY, offered as an IPO and not a SPAC? Not sure if you have any knowledge on this one.
Yeah, so I followed that one. It really depends. Who knows? Like each company will sort of evaluate the positives and negatives between IPO and SPAC, and sometimes they go IPO like Oatly did, and sometimes they go SPAC like Nextdoor did. So it really depends. I wasn't privy to the discussions at the company, and I'm not sure exactly why they pursued IPO instead of SPAC, but thus far over the past year, we've seen basically like 50-50 split between IPOs and SPACs.
Nice. Awesome. Appreciate the insight there on that. We're going to do one or two more here. So one quick one. Is there a difference in the disclosures that a company has to provide when they list via SPAC versus an IPO? Is a SPAC less intensive disclosure-wise?
Yes, that's a great question. And yeah, I'd agree with that sentiment. And as I indicated in the webinar, the SPAC can disclose the company's forecasts, which you cannot do in a traditional IPO. And that's the main difference.
Okay, awesome. And one last one here to finish things off. Do you happen to know off the top of your head the average historical gain on SPACs or SPAC arbitrage? I know you showed a few charts there earlier over time, even just like a ballpark number off the top of your head.
Yeah, I think that investors could expect to generate 7 to 8% annualized over the long term through a SPAC arbitrage strategy with low risk. And that's really what we're trying to do with our Accelerated Arbitrage Fund ETF. Last year was a banner year where I'd say we generated excess returns far above our target just because we went through a big SPAC bull market. However, we're currently in a bit of a hangover in SPACs, and I'm seeing a ton on my screen where you can buy the units below $10, get free warrants, and get that upside when sentiment turns. So, it's a pretty compelling time to be allocating to the asset class, either on your own or through funds. There's some SPAC ETFs in the US as well, and some private hedge funds that do this strategy. But yeah, if you look at some of the prices where they're at, that as long as you're not forced to sell, it is a low risk, good upside opportunity that is differentiated from your traditional stocks and bonds.
Oh, that's absolutely fascinating. No, I really appreciate it, Julian. Unfortunately, we can't get to any more questions just for time constraints today, but a couple of quick housekeeping items to wrap things up. There will be a quick post-webinar survey. It only takes about 30 seconds to fill out. So if you enjoyed today's presentation, or even if you didn't and you have feedback, we would love to hear your thoughts as we improve on these webinars. Giant thank you again, Julian, for volunteering to present and represent Accelerate here. I know I learned a lot. I know our customers learned a lot, and SPACs are definitely a fascinating space to watch in the investing world. Any kind of final closing comments from your side?
Yeah, sorry guys that I couldn't get to all the questions. Feel free to reach out to me. Check out our website, accelerateshares.com. We have a ton of content, a ton of research on SPACs, arbitrage, other alternative investment strategies. So explore that, do some reading. And if you still have questions, email me or message me on Twitter, and I will definitely get to all of them.
Awesome. Thank you again, Julian. And thank you everybody for attending. Have a great afternoon, everyone. Bye-bye.
Bye, everybody.